Hello, Graham. My name is Patrick Swan, and I am the treasurer of Graham Local Schools. In this video, I will explain some of the basics of Ohio property taxes. Graham, like most Ohio school districts, gets a large share of its operating revenue from local property taxes. There are several types and classes of property tax, but for this series of videos, the focus will be on Class 1 residential and agricultural property. All taxes share two common components: tax base and tax rate. Those two things are just like they sound. The tax base is what is being taxed. What is the tax based upon? The tax rate is the percentage of tax paid on the tax base. To get the tax paid or collected, you simply multiply the tax base times the tax rate. A simple example most people are familiar with is sales tax. If you get a $10 meal at McDonald's, that is the tax base, or what is being taxed. If the sales tax rate is 7%, then you pay 7 cents for every dollar of sales. $10 times 7 cents equals 70 cents. Property tax is based on the same general principles, except Ohio uses a few unfamiliar methods and phrases that make it more difficult to understand. Every 6 years, the Ohio Auditor of State works with the county auditors to establish the market value of property, called a sexennial reappraisal. They also do a comprehensive update in this value in the third year between reappraisals. Champaign County had its last update in 2022 and will have a full reappraisal in 2025. Since taxes are collected a year behind or in arrears in Ohio, the new property values will be reflected in 2026 taxes. The tax rate for property in Ohio is called a mill. This is something you've likely heard of but may not know what it is. A mill means 1/1000th or 0.001. For context, 0.1 equals a tenth, 0.01 equals 100th or a percent, and 0.001 equals 1,000th or a mill. That means for every mill of property, you multiply the assessed or taxable value by 0.001. The example of a property appraised at $100,000 is often given to help illustrate. When a property is appraised at $100,000, the assessed or taxable value is only $35,000. If that $35,000 was taxed at 1 mil, it would be multiplied by 0.001. So, for every $100,000 of appraised value, 1 mil would cost $35, 10 mils would cost $350, and 20 mils would cost $700 before exemptions and rollbacks. If you ever have any questions about this topic or others, I encourage you to contact me by phone, email, or schedule an appointment to meet. Thank you for taking the time to watch this video, and please be on the lookout for future videos. I hope you have a wonderful day, and go Falcons!